Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about RYDER System INC quarterly report. RYDER System Inc. offers a wide range of logistics and transportation services to its clients worldwide. The company's business segments include Fleet Management Solutions, FMS, Vehicle Leasing, Rental, Maintenance, Digital Support, Fuel Services, and Used Vehicle Sales, Dedicated Transportation Solutions, DTS, Turnkey Transportation Services, including vehicles, drivers, management, and administrative support, Supply Chain Solutions, SCS, Distribution Management, Value-Added Services, Transportation Management, Brokerage Services, Professional Services, E-commerce Fulfillment, and Last Mile Delivery. These services cater to various client needs, from managing fleets and supply chains to providing specialized logistics solutions. RYDER System Inc.'s stock price has seen a significant increase of over 13.98% in the past year due to a combination of strong financial results, strategic acquisitions, and initiatives aimed at enhancing shareholder value. Key drivers of this growth include strong earnings reports, with double-digit increases across all business segments, strategic acquisitions, such as Cardinal Logistics and IFS, contributing to operating revenue growth, investments in innovative technologies, including AI and next-generation logistics solutions, commitment to returning capital to shareholders through share repurchases and increased dividends, positive analyst upgrades, and market sentiment, with several firms raising their price targets for RYDER. While the third quarter 2025 earnings showed a slight revenue miss, management remains optimistic about achieving earnings growth in 2025. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth drivers. The main contributors to revenue growth are services revenue and lease and related maintenance and rental revenue. Additionally, specific product lines such as ChoiceLease have shown a 3% growth rate in 2025. Revenue decline drivers. On the other hand, several factors have led to revenue decline. These include used vehicle sales and commercial rental, freight cycle and market conditions, demand for outsourced logistics, supply of vehicles and vehicle parts, labor shortages and interruptions, and decreased demand for services and products. Neutral or mixed drivers. Some areas have shown neutral growth, such as FMS operating revenue, while others have experienced mixed results, including SCS and DTS operating revenues. Net income and profit margins experienced fluctuations between the 3 months and 9 months ended September 30, 2025. For the 3-month period, net income decreased by $4 million to $138 million, while the net income margin dropped to 4.35% from 4.48%. However, for the 9-month period, net income increased by $13 million to $367 million, with a corresponding rise in the net income margin to 3.88%. The change in profit margins can be attributed to various factors. The gross margin percentage of services remained consistent at 15%, while lease and related maintenance and rental saw an increase to 36% for the 3-month period and 34% for the 9 months. Fuel services gross margin as a percentage of revenue also rose to 6% in Q3 and 4% for the 9 months. The fluctuations in net income and profit margins can be attributed to decreased demand for services and products, lower profit margins, increased levels of bad debt, reduced access to credit and financial markets, and volatility in customer volumes and shifting customer demand. The company's financial performance indicates a consistent generation of positive operating cash flow. The net cash provided by operating activities from continuing operations has increased over the past year, with a notable rise from $1,707 million in 2024 to $1,845 million in 2025. This trend suggests that the company is effectively managing its operations and generating sufficient cash to support its business growth. The company's financial summary reveals a mixed picture regarding its debt level and interest expenses. While total debt decreased by $499 million from $7,779 million to $7,280 million, the percentage of variable rate debt increased from 18% to 22%. However, there is no significant change in total debt level mentioned elsewhere. Regarding interest expenses, a consistent trend emerges, an increase of +4% for both the 3 months and 9 months ended September 30, 2025. This suggests that the company's interest expenses have indeed changed significantly, albeit at a moderate rate. The company's financial performance varied across different segments and regions. The Fleet Management Solutions, FMS, and Supply Chain Solutions, SCS segments performed well, with FMS experiencing an 11% increase in earnings before taxes and SCS seeing a 12% rise in earnings from continuing operations before income taxes. In contrast, the Dedicated Transportation Solutions, DTS segment struggled, with revenue declining by 10% in the third quarter. The Services segment also underperformed due to decreased gross margin. No significant decline or improvement was mentioned for the United States, Canada, and Mexico regions. Management is cautiously optimistic about the company's outlook despite short-term challenges. They expect long-term revenue and earnings growth opportunities driven by demand for outsourced logistics and strategic initiatives such as lease pricing and maintenance cost savings in fleet management solutions. The company plans to drive growth through prior acquisitions, with the SCS and DTS business segments expected to be key drivers of revenue and earnings growth. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid $0.91 per share in October 2025 and $0.81 per share in October 2024. Additionally, the company has also been actively buying back shares, with a total outlay of $350 million in 2025 and $282 million in 2024. Concerns about inventory buildup and supply chain disruption are valid. The industry is facing an extended freight downturn and unfavorable e-commerce network performance, page 34. Additionally, commercial rental power fleet utilization has decreased from 73% to 71%, page 44, indicating inefficiencies in the supply chain. Furthermore, production delays at automotive SCS customers due to supply chain disruptions are being reported, page 58. Original equipment manufacturers or suppliers are unable to provide vehicles or vehicle components as originally scheduled. Labor shortages affecting professional drivers, warehouse personnel, and technicians are also contributing to these issues. These factors collectively indicate a fragile supply chain that is vulnerable to disruption. That concludes the financial summary for RYDER System INC. Feel free to comment below, and I will be happy to answer them when possible.